UnitedHealth Group has been through one of the wildest stretches in its history. In just the past year, we've seen a massive cyber attack that disrupted providers across the country, the abrupt departure of CEO Andrew Whitty, a Department of Justice probe into Medicare Advantage practices, guidance being pulled and then reset, and spiking medical costs that caught the company and the market by surprise. The stock sold off hard, investors panicked, and then suddenly Berkshire Hathaway shows up with more than $1 billion position. It's a rare moment where a blue chip franchise is in the headlines for all the wrong reasons, yet some of the smartest investors are quietly buying. So what's really happening here? Let's break down why the stock dropped, what the company actually does, where the moat lies, and why super investors like Warren Buffett are willing to lean in when most of Wall Street is nervous. At its core, UnitedHealth is not just an insurance company. It's two massive flywheels under one roof. On one side, you have UnitedHealthcare, which is the benefits business. This is where they sell commercial health plans to employers, provide coverage through Medicaid contracts, and run one of the biggest Medicare Advantage businesses in the country. On the other side is Optum, which is the services platform. Optum itself has three big arms: Optum Health, which delivers care and manages patients directly; Optum Insight, which is the data, analytics, and technology side; and Optum Rx, which is the pharmacy benefits manager. The key is that these two sides are deeply integrated. UnitedHealthcare buys and prices risk, while Optum delivers, optimizes, and monetizes the care. The data flows between the two, creating a feedback loop that is very hard to replicate. Scale here is almost unimaginable. In 2024, UnitedHealth generated close to $400 billion in revenue. Optum Health alone manages care for tens of millions of people. Optum Rx processes billions of prescriptions each year. And UnitedHealthcare has an enormous footprint in both employer coverage and Medicare Advantage. It's the largest private health platform in the United States. That size gives the company leverage when it negotiates with providers and pharmaceutical companies, and it lets them spread fixed costs over a giant membership base. So why did the stock drop so much recently? The biggest driver was medical cost trend, especially in Medicare Advantage. In 2025, the cost of providing care to seniors enrolled in these plans ran much higher than expected. We're talking about a trend closer to 7.5%, compared with just over 5% that was priced into the bids. That kind of gap is painful because in Medicare Advantage, the government pays the insurer a set amount per member per month, and the insurer has to make it work. If people use more services or if the unit cost of care goes up, the company eats the difference. When those numbers started coming in hot, margins got squeezed and management had no choice but to pull guidance. Later, they reestablished their outlook, but with higher assumptions for medical costs baked in. Right around that time, CEO Andrew Whitty announced he was stepping down, and longtime executive Stephen Hemsley came back in to stabilize the leadership. Layered on top of that were headlines about the Department of Justice launching both criminal and civil investigations into how UnitedHealth handled Medicare Advantage billing and risk adjustment. Those probes add uncertainty and scare away some investors, even if the ultimate outcome is likely to be fines or tighter controls, rather than an existential threat. And all of this happened while the company was still working through the fallout from the Change Healthcare cyber attack, which disrupted payment systems and forced UnitedHealth to spend heavily on remediation and provider support. Put it all together, and you had margin compression, leadership turmoil, regulatory risk, and operational headaches all hitting at once. The stock sold off and the multiple compressed, and that's exactly when the super investors started buying. In the second quarter of 2025, Berkshire Hathaway disclosed a new position of just over 5 million shares, worth about $1.6 billion at the time. For a company like Berkshire, that is a meaningful bet, and it's not the kind of name they typically buy unless they think it's both durable and temporarily mispriced. Other managers like David Tepper's Appaloosa also boosted their positions. Their logic is pretty simple. This is a world-class franchise facing what look like temporary shocks. If medical trend normalizes in the 2026 bids, if Optum recovers from the cyber attack, and if the DOJ outcome is manageable, Then earnings power snaps back, and you bought a best-in-class company at a cheaper multiple than usual. So let's zoom in a bit on how the money actually flows. On the United Healthcare side, commercial business is split between risk-based insurance, where they take the premium and pay the claims, and fee-based administrative services only, where the employer bears the claims and United Health just provides the network and admin for a fee. In Medicare Advantage, revenue is a per member per month payment from the government, adjusted for the risk profile of the members. Star ratings play a big role here because higher ratings bring bonus payments. Medicaid is a little different because contracts are state by state, and membership can swing a lot depending on eligibility redeterminations. Over at Optum, the revenue streams are diverse. Optum Health makes money through value-based arrangements where they receive a set amount per member per month to provide all care, plus fee-for-service through their clinics. They also manage care programs and even financial products like health savings accounts. Optum Insight sells technology platforms, revenue cycle services, and analytics tools to other payers and providers. That's the part that was most affected by the Change Healthcare cyberattack. Optum Rx is the pharmacy benefit manager. Here the economics come from rebates, spread pricing, specialty pharmacy margins, and mail order. Specialty drugs in particular are a huge growth area and a profit center because they're high cost and high margin. The moat for United Health is built on a few pillars: scale, data, integration, relationships, and regulatory know-how. No other company has this combination of insurance, pharmacy, provider, and data all under one roof at this size. The claims data, the clinical data, the pharmacy scripts, and the payments information create a data set that gives them an edge in underwriting, fraud detection, and care navigation. That data advantage compounds over time. Vertical integration means they don't just pay for care, they deliver it and steer it. Distribution relationships with employers, with states, and with the federal government are deeply entrenched. And perhaps most underrated, this is a company that knows how to operate in regulated markets like Medicare and Medicaid. That doesn't make them immune from scrutiny, but it does mean they understand the rules of the game and have decades of compliance muscle. Looking forward, the bull case rests on a few things going right. The big one is that medical trend normalizes. As we get into the 2026 Medicare Advantage bids, those higher costs will be priced in. If utilization moderates even a little, margins improve. The fallout from the cyber attack should fade over time as systems are rebuilt and stabilized. Optum Health has plenty of room to grow as value-based care expands, and Optum Rx is positioned to capture more specialty volume. With the stock trading at a discounted multiple compared with its 5-year average, buybacks could add extra juice to earnings per share. And if the DOJ process ends with a fine or a settlement rather than structural changes, the overhang clears. Put that together and you have a path back to double-digit earnings growth. The bear case is the mirror image. If medical trend stays high even after 2026 bids, margins could remain under pressure for longer than anyone expects. A harsher DOJ outcome or a shift in policy that cuts into Medicare Advantage economics could fundamentally change the model. Star rating downgrades would mean less revenue per member. Optum could stumble again on execution, especially in technology at Insight. And there's always the risk that provider relationships suffer lasting damage from the cyberattack episode, leading to share loss in key markets. So where does that leave valuation? Without putting price targets on the screen, the framework is straightforward. In a base case, you assume the 2026 bids reset expectations, utilization moderates, Optum margins recover, and consolidated earnings power is restored. In a bear case, you hold trend high, layer in regulatory drag, and assume slower recovery. In a bull case, you get faster normalization, better Optum growth, and a steady buyback. What makes the stock attractive to long-term investors is that the downside scenarios are tough but manageable, while the upside is meaningful if the headwinds fade. In short, UnitedHealth today is a world-class healthcare machine that's been knocked around by medical cost spikes, leadership drama, regulatory scrutiny, and a cyber attack. The market is nervous, the multiple is compressed, and the headlines are loud, but the fundamentals of scale, data, and integration are still in place. That's why Berkshire and other super investors are willing to step in. They see a durable franchise temporarily off balance, Sace. Whether this plays out as a value trap or a classic Buffett-style dislocation depends largely on medical trend and the DOJ outcome. For now, the company is in the middle of the storm. But if history is any guide, storms pass, and the biggest players with the deepest moats often come out stronger on the other side. Thanks for watching. See you in the next one.